Okay, in this part of learning module number 8, we are going to talk about unrelated business income tax, or UBIT as it's known. Okay, so understanding UBIT can be a bit challenging. The best way I know to think about it is to start from the idea of you have to understand what your organization is there to do. You have to go to your mission and you have to figure out, okay, how do I go about accomplishing that mission? What are the things that I do on a daily basis that help serve that mission? And they may bring me revenue, which is great. That's going to be related business income, right? Things that I do. So I run a zoo and people pay me admission. Well, that's money coming in, but it's absolutely related to my mission of helping people, enjoy the animals. Unrelated income are things that I do that have nothing to do with or not substantially related to what I do as a mission and as programmatic. And so the IRS has determined that if a nonprofit organization has unrelated income of more than $1,000 per year, that organization has to pay tax on that money. The reason that this started was organizations, they didn't want nonprofit organizations competing with for-profit organizations, and for-profit organizations would have to pay tax on what they earn, but nonprofits wouldn't. So how they define, they being the IRS, how they defined unrelated business is it's not related to the organization's mission. It's something that they do regularly, so it's not a one-off opportunity, and it is a trade or business. And what that means is it's designed to make money. It's not there to help support the mission. Okay, so here's an example. Let's just say I've been running my dog shelter in the city of Grand Rapids for 5 years, and I get this great opportunity to move to a new location. So I move, but I decide I'm going to keep my old location, my old building, and I'm just going to rent it out. So I'm going to have another tenant in there that has nothing to do with me running the dog shelter, and maybe I also have a great parking lot attached to that building, and I decide to, hey, parking's tight in Grand Rapids these days, so I'm going to rent that out too, and I'm going to let somebody operate a commercial parking lot there and charge people $5 to come in and park. Well, none of that is related to running a dog shelter. It doesn't have anything to do with saving dogs and helping them find forever homes. It is providing income for my organization, which does help support the mission, of course, but it's not related to the mission. And so that would be, and all the money that I would make from my rentals or my parking lot fees would be taxable and would be subject to UBIT. The IRS has set up some exceptions to UBIT. So if your nonprofit organization is doing one of these things, then you don't have to pay taxes on the income that's generated. So businesses conducted solely by volunteers. So if I've got volunteers who, decide that they're going to have a bake sale, well, they don't have to pay tax on the money that they earn from that bake sale. Even though the bake sale has nothing to do with my mission and it is just to generate funds, if the volunteers take it upon themselves to do it, I don't have to pay taxes on it. Convenience businesses. So the example that they gave in the reading that I think is a good one is, I have a museum or a zoo and I want people to stay there all day. And so I have to, give them an opportunity to buy a snack or buy lunch. And so I operate a shop or I operate a restaurant. Well, that's convenience for my attendees, my customers, and so that would not be taxable. And then likewise, if I run a gift shop, that would be another convenience business potentially. Now, sales of gift items. That is, I don't know if you remember back, but early on we were talking about thrift stores. And this is where I think it came up in a discussion board in like Learning Module 2 or 3. Well, here you go. Sales of gift items. So if people are donating things to me and my thrift store and I resell it, I'm not buying the items for resale, but I am getting them donated. I do not have to pay tax on those items or on the sales of those items. So what are some examples of UBIT? Advertising income. Let's just say that I'm in a great location and I put up a billboard and on the top of my building because it's right by, I-75 or I-96, and I'm just getting advertising income. Well, that would be taxable. Rental income from a debt finance property. So I'm owning a property and I'm just renting it out. Again, that would be unrelated and I would be taxed. Income from controlled organizations. So this might be an organization that I own that's, I'm a wholly owned subsidiary of this. Sometimes you'll find nonprofit organizations, especially in the Head Start and early childhood. It is a federal requirement that the organizations are not able to own directly the facilities in which they operate. So they usually set up a holding company, in a complicated kind of LLC structure or something along those lines. And if I'm receiving income from those, then that would be, I've set up this organization primarily to do something that isn't related to my mission. So of course that would be taxable if it was income producing. So with that, I think that's what I wanted to say about UBIT. What I want you to understand is that, if I am subject to UBIT, I do have to file a separate 990T, it's called, and that does not have to be publicly disclosed, but I do have to file basically along the same timelines that I'm filing my regular 990. So now I want you to go on to how to read a 990, and you're going to want to have out the Matrix Theater Company 990s that are also available in Learning Module number 8.